In this episode from BMO Equity Research's Metal Matters, Helen Amos discusses new highs in gold and silver prices as transatlantic tensions around Greenland's future escalate. We look at how U.S. metals stockpiling over Trump's second term compares with the Cold War era, and reflect on new questions around China's aluminium output, met coal's steady comeback, and tin's outperformance. Let's dive in.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes.
Welcome back to Metal Matters. This is our first episode of 2026, and what a start of the year we have had for metals markets already. Now, if we thought 2025 was a major year for geopolitical twists and turns, not least the ratcheting up of trade wars, well, the first few weeks of 2026 have been seismic already. It started with the US capture of Venezuela's President Maduro, before Trump's focus rapidly turned to Greenland, with the US ramping up pressure on Denmark and other European countries via tariff threats to agree to Trump's plan to fully acquire the territory. On the metal side, well, no surprise that major geopolitical risk events like these are supportive of the precious complex. This week has brought yet new record highs in gold and silver, with gold seeing a notable pickup in ETF inflows again, driven largely by North America. That being said, we may be finally starting to see momentum in silver beginning to wane. The gold to silver price ratio has been stabilizing at around 50 in recent days. And in a recent report from our team, we show that over the very long run, there is quite a consistent relationship between this ratio and the physical surplus, so before we account for investment flows. So we think we could actually be near the bottom now of the ratio as we see this physical surplus widening again. We also do note, though, that Chinese authorities have been stepping in to try to curb the volume of high-frequency trading on various metal exchanges, which may also be helping to cool the effect of speculative retail activity on prices a little bit. We think this has been particularly an issue in exacerbating volatility in silver and lithium in recent weeks. Now, in base metals, we've seen a slight reprieve this week after some steep moves higher over late December and early January, especially in copper. Now, copper has pulled back a little bit, but is still holding quite close to its recent records. And those US cathode imports that have been such a key part of the story over the last 12 months are just not relenting. And because of this, we're seeing tightness again in LME inventories, which is steepening the backwardation at the front end of the curve. Now, aluminium prices are holding up fairly well too, but we're yet to have a sustained period of outperformance in aluminium versus copper, which is what I think some investors entered this year holding out hopes for. In fact, if anything, the opposite has been true, so copper has been outperforming aluminium. Now, we had China's National Bureau of Statistics reporting full-year production data for 2025 earlier this week. So this came in at 45.02, to be precise, million tonnes. And this is slightly above the level that some would see as China's official cap. And we have been getting quite a lot of questions around this. Now, it is a murky area. There are several different versions of the truth out there on, one, what the level of the cap actually is, two, whether the cap relates to annual production or installed capacity, and three, what China even produced last year. So China's cap is really central to the bullish thesis many have been holding on aluminium right now. So I think it's no wonder that there's been so much scrutiny on the new set of data that we've had. Now, with smelting margins, the best they've been for decades, and aluminium fundamentally is a downstream metal that is rarely bottlenecked by mine supply in the same way that copper is. We are a little more on the cautious side from here than others. So, what about the other metals? Well, tin does deserve a special mention. Prices have already surged by around 20% this year, far ahead of the other base metals, having also outperformed the rest of the complex last year too. Now, prices briefly spiked above $52,000 a tonne last week, but have since calmed down a little bit. We are seeing some really big swings at the moment in metal inventory and LME warehouses. These are now rising sharply, and I think that's something to keep an eye on. But at the same time, I think we still have a good fundamental story here for tin, especially on the supply side, given that we have had production issues in major producing countries like Myanmar and Indonesia, where in fact 6 tin smelters were actually seized last year and nationalised by the government. And this supply story meets a really good story on the demand side, given the strong pull from the electronics sector. Now, over to the bulks. We're seeing met coal continue its steady recovery from the ashes, with physical spot prices now assessed at around $240 a tonne. We were pretty cautious on met coal for much of last year, but we think we're finally starting to see the key ingredients coming together now to help give the price recovery more legs from here. And that's namely, one, commitment from China to rein in overcapacity in the coal sector, and two, finally, a revival in Indian imports. Now, India is the second largest import market for met coal after China. And we've seen a few things change here after seeing its imports lag behind hot metal production for several years. And those changes relate to policy factors around steel and coke imports. But we're also seeing this really good overall momentum now in India's industrial economy. And we also have near-term tailwinds from the usual seasonality of Australia's exports over the cyclone season, which tend to dip over the first few weeks of the year. And we've also had some recent rail disruptions in Russia too. And I'd also just add that met coal, from across all of the mine commodities that we look at, has one of the highest direct demand exposures to India. So if you're becoming a bit more constructive on India's development, particularly its steel production growth, then met coal is a commodity to watch. Now, the final topic I want to talk about today is US metals stockpiling. Now, this huge buildup of metal inventory in the US, especially copper, which is an outcome of potential future tariffs, this has been such a big theme in the metals complex over the last 12 months. And so the pathway for this inventory from here, I would say, is probably the single most important debate in metals right now, in my view. And I think it's fair to say that we have this global geopolitical context that's evolving so rapidly at the moment, especially Trump's reassertion of the Monroe Doctrine as part of the USA's new national security strategy, and the developments that we've actually seen play out in Venezuela and Greenland in January this year. And I think this could change the way we think about potential outcomes now for metals inventory in the USA and perhaps even other countries over the coming years. Now, when we try to assess the level of metal inventory that the US has accumulated over Trump's second term so far, we find that in relative terms, so relative to the underlying rate of demand, the inventory build has been the largest so far in copper, but shortly followed by platinum and then palladium. Now, interestingly, in other metals, we have in fact seen an implied inventory drawdown over the last 12 months. Now, if you think about steel and aluminium, I think this makes sense because these metals were already subject to Section 232 import duties, which had existed from the first era of tariffs under Trump's first term. And then these duties were hiked quite abruptly to 50% last summer with quite little notice. So that didn't really leave market participants with much opportunity to buy ahead of future tariffs, which is the dynamic that we've seen in copper. I think maybe more surprisingly, though, while we have seen a build-up of visible inventory levels in COMEX depositories and in gold and silver over the last 12 months, when we look at the trade data, this actually suggests that overall, there's been quite a big drawdown in inventory levels of gold and silver in the US over the last 12 months, which must therefore arise from a drawdown from vaults off exchange, so off COMEX exchange. So the question then is, what happens next for metal stockpiles? Well, some voices in the market do seem to be narrowing in on a scenario whereby at some point over the coming weeks or months, this huge copper stockpile that has accumulated in the US ultimately disperses, and that relieves tight inventory levels elsewhere, and ultimately that would deflate prices in the process. However, when we compare today with inventory levels that we saw in the US many, many decades ago, so when we look back at data of the inventory of copper that was held by the US actually over the Cold War era, we find that today actually doesn't look so dramatic at all, in fact. And plus, back then, the US enjoyed a much higher level of copper production self-sufficiency than it does today. So I think the takeaway from this is that if we think the US actually sees its metal inventory through more of a strategic lens, not just as an unintended side effect of tariff uncertainty, we could start to entertain quite a drastically different scenario for US metal stocks in the coming months or even years than I think is being assumed by the market today. That brings me to the end of this podcast. Now, BMO's 35th Global Metals, Mining and Critical Minerals Conference is now just around the corner. So for those of you who are attending, my colleagues and I really look forward to seeing you in Miami in a few weeks' time.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.